What if the greatest economic collapse in modern history wasn't an accident? What if the crash of 1929, the one that destroyed millions of lives, broke families, and reshaped the 20th century, had been planned, step by step, by a handful of men who already knew what was coming? Sounds insane, but hold on. Because what I'm about to show you isn't a theory. It is historical record, hiding in plain sight, in the Federal Reserve's own reports and in letters exchanged between Wall Street banks. And the scariest part? The same mechanism that triggered the 1929 collapse still exists today, just under new names: global liquidity, derivatives, open market operations. The labels changed, not the essence. While you're watching food prices rise, rent double, and your paycheck shrink, remember, the game never stopped. It just went digital, faster, quieter, invisible. Before we dive into this web, tell me, where are you watching from? And if you want the unfiltered truth about how money really works, subscribe now. Because what's coming next will change how you see the entire modern economy. Here's what the official story says. In 1929, the stock market went too high, driven by speculation, optimism, and cheap credit. Then one day the bubble popped. End of story, right? Wrong. The real machine started turning in 1913 with the creation of the Federal Reserve System, the central bank of the United States. Publicly, its mission was to stabilize the financial system, but its real function? To control liquidity, credit, and the cost of money. In the 1920s, the Fed kept interest rates artificially low, around 3.5%, flooding Wall Street with cheap credit. The result? Millions of Americans began buying stocks on margin. You'd put down 10% and borrow the rest. It seemed magical. Profits were easy. Until someone turned off the tap. Sound familiar? Today they call it quantitative tightening. In 1928, the Fed began reversing liquidity, raising rates to curb speculation. But who got the heads up first? The New York investment banks. Morgan, Rockefeller, Kuhn Loeb, National City Bank, all started liquidating positions months before the crash. Meanwhile, the public was urged to keep buying. Newspapers, conveniently funded by those same banks, proclaimed, "The American market is unbeatable." Sound familiar? In 2008, they called it subprime. In 2020, emergency liquidity. In 2023, soft landing. History repeats, just with fancier suits and Excel spreadsheets. Then came October 24, 1929, Black Thursday. Sell orders hit automatically. Margin calls exploded. In just 48 hours, $30 billion vanished. The equivalent of an entire year of U.S. industrial output. And who bought those stocks back for pennies on the dollar? The very same banks that had sold them at the top. Sound familiar? Today, when markets crash, central banks rush in to buy bonds, stocks, and corporate debt. They call it stability intervention. But it's the same trick as 1929, just with computers and digital trillions. Now here's the part most history books skip. Between 1927 and 1929, the New York Fed, led by Benjamin Strong, orchestrated something called the cross-liquidity agreements. It was a silent pact between the Fed, the Bank of England, and Germany's Reichsbank. Officially, it was international monetary cooperation. In practice, it was the first global currency manipulation network. Records show billions in gold and credit transfers between New York and London, artificially adjusting the value of the dollar and the pound. Meanwhile, the U.S. market inflated faster than ever. When Benjamin Strong died in 1928, the Fed's internal balance shifted. A more moralist faction, led by George Harrison, decided to slam on the brakes. It was like cutting oxygen in a room full of gas. Within a year, the system imploded. And who profited from the wreckage? The very banks sitting on the Federal Reserve Board. You won't believe whose name shows up in the confidential 1930 reports. The receipt is wilder than you think. Ever wondered if the greatest economic crash in history was actually a heist? Let's talk about the hidden machine that pulled it off. Most people think the Federal Reserve failed in 1929. The truth is much darker. It did exactly what it was designed to do. It was a masterclass in redistributing wealth, consolidating banking power, and making the government and its people dependent. So, how did they do it? It was a triple trigger system. First, cascading credit. By 1928, banks had loaned out a staggering $8 billion in margin loans. To put that in perspective, that was 20% of the entire US GDP. It looked like a booming economy, but it was a house of cards built on pure leverage. Second, liquidity manipulation. The Fed, operating through its New York branch, was playing a dangerous game. They would inject and then drain credit from the system, sometimes weekly. A tiny 2% squeeze on bank reserves could instantly vaporize $1 billion in Wall Street capital. Imagine having that kind of power at your fingertips. And the third trigger? Insider information. The Fed's directors weren't just public servants. They were also top executives at the very commercial and investment banks they were supposed to be regulating. It was an inside game from the start. Today, we'd call it institutionalized moral hazard. They were playing with a stacked deck, and the public didn't even know the game was being played. But here's the real kicker. The primary mechanism of this whole conspiracy, the parallel liquidity market. Think of it as the great-grandfather of today's shadow banking system. It was a secret network of repos and something called acceptance bills that allowed Wall Street to fund massive operations completely off their official balance sheets. These transactions were totally invisible to the public and to most regulators. They created a perpetual cycle of phantom credit. Banks would offer private liquidity to each other in exchange for repackaged collateral, things like debt securities, mortgages, and export notes. By 1928, the value of these secret instruments had ballooned to over $26 billion. That's 3 times the entire US gold reserves at the time. And guess what? Not a single one of these transactions was ever audited. So when the Fed decided to tighten the screws and reduce liquidity in the official system, it was this shadow system that collapsed first. Banks that relied on this phantom money suddenly found themselves broke. They were forced to start liquidating assets, calling in loans, and selling off stocks. This triggered a catastrophic domino effect. The entire pyramid of leverage came crashing down, and it was ordinary American families who were left to pick up the pieces. Now, does any of this sound familiar? It should. Fast forward to 2008. The same mechanism reappeared, just with new, fancier names. Collateralized debt obligations, or CDOs, and credit default swaps. It was the same shadow banking game, just on a global scale. In 2020, during the pandemic panic, they called it emergency repo operations, injecting trillions to prevent another collapse. And right now, today, the Fed is pumping $120 billion a month in digital liquidity into the markets to keep this very same house of cards from falling. Let's look at who wins when the system breaks. In 1929, JP Morgan emerged as one of the biggest winners of the collapse. They swooped in and bought up devastated, devalued assets at a 70% discount. In 2008, who bought the failing Bear Stearns with direct financial help from the Fed? The very same JP Morgan. And just last year, in 2023, the cycle repeated itself when JP Morgan, with government backing, rescued First Republic Bank. Is this all just a massive coincidence? Or is it a self-regenerating system designed for financial concentration, where the same players always win? The reality is, the Federal Reserve acts as the bank for the big banks, not as the people's bank. It doesn't represent the real economy, the one you and I live in. It represents the creditors. And the 1929 crash was the perfect prototype, the first successful test of this system of fiduciary control. The consequences were devastating. By 1933, 9,000 banks had failed. Unemployment skyrocketed to 25% of the workforce. The country's industrial production was nearly cut in half, falling by 47%. But while the country suffered, something else happened. The nation's gold reserves were centralized in Fort Knox, and the Federal Reserve's power tripled. So here's the big reveal, the truth they don't want you to know. The 1929 crash wasn't a mistake. It was a successful experiment in total economic control. The Fed discovered it could destroy real wealth and create political dependency, simply by adjusting one single variable: liquidity. Almost a century has passed, and fundamentally nothing has changed. It's just faster. Algorithms have replaced the old-school brokers, complex derivatives have replaced gold, and now economic crises have replaced wars as the primary tool for restructuring power. Today, the same Federal Reserve that once promised financial stability now holds an $8.5 trillion balance sheet. It manipulates, directly or indirectly, 95% of all global liquidity. Every time they adjust interest rates, it sends an economic earthquake across the entire planet. And where do we fit into this picture? We're just the extras in a play that was first rehearsed back in 1929. The current bubble, whether it's public debt, student loans, or the new climate derivatives, is just a new version of the same old script. And when the next crash comes, and it will come, don't expect honest explanations. Expect to hear words like bailouts, stimulus, and emergency interventions. That's the modern code for a massive wealth transfer from the many to the few. The truth is simple, but it's brutal. The system is not designed for you to understand it, because the moment you truly grasp how it works, you become free from its control. But the clock is ticking, and the next collapse, which will be digital, automated, and global, is set to be the biggest one yet. The only real question is, when the dust settles, which side of the equation will you be on? If you've watched this far, it's because you're someone who seeks the unfiltered truth. So I want to ask you, do you think this system can still be fixed, or was it built to break from the very beginning? Let me know your thoughts in the comments below. And of course, subscribe for more content that challenges the official story. We might be wiser now, or we might just be walking down the same old road, just in fancier clothes. Thanks for watching.